Hello, this is Bob Steele. In this lecture, we will continue on Chapter 10. We are now talking about the additional expenditures. And remember, we're talking about property, plant, and equipment. We're talking about things like buildings. We're talking about land. We're talking about equipment that we had to put on as an asset and then depreciate over a time period. So if we add additional things to the asset, for example, if it was a car and we added a new engine to it, or if we did services on it, or if it's a building and we added a roof, or if it's a building and we added paint or something like that, there's a question as to whether we should capitalize those items or if we should expense those items that happen in the future. So the two things that we could do to property, plant, and equipment are to add expenses that we can capitalize expenditures or our revenue expenditures. That means that we either put the new item, the maintenance or the new roof or the new engine, as a capital expenditure when we pay for it sometime in the future, just like we did when we put the original asset on for the most part, or we expense it as we incur these costs in the future. If we were to capitalize, just like when we put the asset on the books, we would then put it on the balance sheet. We debit an asset, just like we did when we put the original building or the original equipment on the balance sheet, and we credit cash or whatever we used to pay for the improvements. And that would mean that the expense is deferred. That means that we're not incurring the expense today because we put it on as an asset, and we will incur the expense over its useful life, just like we did with the original asset when we put it in there. The current income would be higher in the current years for that reason, because it will not affect net income if we put it on the books as an asset, and it will affect net income as we depreciate it. That means that the current taxes will be higher, because in the early years we won't be expensing it, which would bring down net income, which brings down taxes. If, on the other hand, we treat it as a revenue expenditure, remember, that basically just means we're going to expense it at the beginning. So those two terms can sound contradictory. We're talking about treating these items as an expense when we pay for them. And if we did that, then it would affect the income statement when the item happened, when we did the maintenance and whatnot. And as far as the expense would go, it would be currently recorded, meaning we record the expense when it happened rather than capitalizing it and recording the expense over the life. And the current income statement, so the current income would then be lower because we have now recorded the expense, which reduces net income. A reduced net income would make for lower taxes. So what would allow us to make these decisions? When would we decide, should we include other repairs on the building, on the car and whatnot? Should we include those as an asset, or should we expense them? So if it was ordinary repairs, the idea being if it doesn't extend the useful life or put the asset into some other form of function than it was originally purchased for, if it's just to maintain the normal function, then it would be generally a revenue or an expense when we incur it, meaning we would expense an oil change, we expense normal maintenance, we expense normal wear and tear on a building in order to bring it back to its original state, rather than if we were to put a new roof on the building, then maybe we would want to capitalize that. So identifying characteristics: maintains normal operating condition, does not increase productivity, does not extend the life. If that's the case, we're just going to basically expense the future items. If, on the other hand, betterments and extraordinary repairs, then we'll capitalize it. So if there's a major overhaul or partial replacement, or if it extends the life beyond the original estimate, then we should generally capitalize it. Disposal of a plant. So disposal of a plant asset, we're gonna at some time in the future, we may get rid of the plant assets. In the future, we're gonna get rid of our property, plant, and equipment. When we dispose of it, we're getting rid of it, we're throwing it away, we're giving it away, we're selling it. We're gonna update the depreciation to the date of the disposal. Then we're gonna journalize the disposal by recording cash received and or paid, recording the gain or loss on the disposal, and removing accumulated depreciation, removing the cost of the asset. So this sounds complicated, but once again, if you look at the trial balance, this becomes a lot more simple to look at. And a lot of problems We don't have the trial balance, so I suggest having a trial balance in front of you, even if the problem does not give you one. And then it becomes a lot easier, because in real life we would know what the equipment was on the books for. So for example, let's say we sold this piece of equipment for $50,000. We can see that it has a book value of 37, which is the cost minus the accumulated depreciation. If we got cash of $50,000, the journal entry would be cash would go up. We know cash is a debit balance right here. It goes up by doing the same thing to it, which would be another debit. So I could debit cash. That would go up by the 50. And then if this was one piece of equipment, that would have to go down to 0. So I'd have to make that go down to 0. So that would be a credit. This is a debit balance. I'd need to do the opposite thing to it. So we would have to credit that by whatever's in there, by the 135.3. But we'd have to also get rid of the accumulated depreciation. The accumulated depreciation is related to the equipment. It needs to go down to 0 too. It has a credit balance, the contra asset account. How do we make it go to 0? We do the opposite thing to it, which in this case would be a debit. That's a credit. We're going to debit it to make it go down to 0 for 97,950. Now our debits do not equal our credits, so that adds up to 147,950. This adds up to obviously 135.3. I'm going to put the plug in there, which needs to be a credit here. So now the debits are 147,950. The credits are 147,950. The question is, what account do we put that to? Well, we just said that the equipment had a book value of 37,350. We sold it for 50. Therefore, we made a gain on this transaction. We earned money. We made profit on it in some way, or we over depreciated in the past is what kind of really happened. Therefore, we have an account called here says gain or losses. Gain being a credit, increasing net income. So we can say, okay, the other account is going to be a credit, increasing net income. So what would happen? This number is going to go up by the 50 because it's a debit and a debit. The equipment, if I was to post this, will go down to 0. And the accumulated depreciation related to the equipment also must go down to 0. And then we'd have this gain on the sale, which would put us back in balance. That gain increased net income, meaning the credits are now winning by more over the debits because of that gain. So if we look at that in a general basis, discarding plant assets, if the cash is greater than the book value, we're going to have a gain. If the cash we receive is less than the book value, we're going to have a loss. And if the cash that we received equals the book value, then we'll have no gain or loss. That won't generally happen because that would mean it was a perfect world and we happen to sell it for exactly what is on the books. And we know that the depreciation is an estimate, and we're going to sell it in real life for whatever we can get for it, the most we can get. Therefore, when we sell it, it's very unlikely that we're going to sell it for exactly what the book value is on our books. So here's a quick example. Notice the examples, once again, will not give you a trial balance oftentimes. It's really good practice to have a trial balance in front of you so that you can look at these accounts and say, are these accounts debits or credits? Are they going up or down? A lot easier to visualize that if you have a trial balance in front of you, even if the trial balance doesn't reflect exactly the numbers that we are looking at. So a company pays $1,000 for equipment expected to last 4 years and have a 200 salvage value. Prepare journal entries to record the following related to the equipment. During the second year of the equipment's life, 400 cash is paid for a new component expected to increase the equipment's productivity 20%. Okay, so first we purchase the equipment. A company pays $1,000 for the equipment. So if the equipment's a debit, we're going to make it go up by doing the same thing to it, which is a debit. We paid cash. Cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit. This records the purchase. During the second year of operations life, 400 cash is paid for a new expected to increase the equipment's productivity. The question here is, should we capitalize it? Should we expense it? The key term here is we're increasing the life, therefore we're going to capitalize it, meaning we're putting the debit to an asset, not an expense. We're increasing the asset instead of increasing the expense, and therefore we're going to debit the 400 and credit cash, reducing cash. Then B says during third year, 250 is paid for normal repairs necessary to keep the equipment in working order. Key term here is normal repairs. So same question, should we capitalize it or expense it? This time we should expense it because these are normal expenditures. Therefore, we're going to debit expenses, reducing net income, and we're going to credit cash. So the difference between these two being one got debited to the asset, one the expense, because of this one extending the life and this one not extending the life. And then C, during the fourth year, 500 is paid repairs expected to increase the useful life. Again, we're increasing the useful life. Should we capitalize or should we expense? In this case, we capitalize. How do we know? We debited an asset, increasing the asset, rather than increasing the expense. And once again, cash will be credited. Okay, a company owns a machine that costs 500 and has accumulated depreciation of 400. That means it has a book value of 100, 500 minus the 4. Prepare entry to record the disposal of the machine on January 2nd under each of the following situations. The machine needed expensive repairs and it was not worth repairing. The company disposed of the machine, receiving nothing in return. So the machine, here's the T account, is on the books. It has a debit balance of 500. So if we purchased the machine, we debited the 500, we credited cash. That's to record the purchase. And then over its useful life, what happened is that we recorded depreciation over the life up until now, a debit of 400 to the depreciation expense, accumulated depreciation 400. Therefore, we have on the books 500 asset, 400 contra asset, book value being 500 minus 4, 100. All right, so then we can take a look at A. The machine needed expensive repairs, not worth it. The company disposed of the machine. We didn't get anything in return. We didn't sell it. We just threw it away. So what do we got to do? If this is a debit balance, we need to make it go down to 0. Therefore, we're going to credit the machine, making it go to 0. This has a credit balance. We also need to make that go down to 0 because it's related to the machine that we gave away. Therefore, we're going to debit that. The difference between those two, in this case, is a loss. So we know what the plug is because we have to equal the debits and credits. We needed $100 in order to plug. Then the question is it a gain or a loss on the sale, on the disposal in this case? And in this case, it's going to be a loss. The debit means it's a loss because remember, we're talking about either revenue or expenses, really. We're talking about an income statement account. And on the income statement, credits are income, basically, or gains, and debits generally decrease net income, are kind of like expenses. So in this case, we decrease net income by increasing the loss. Okay, B, the company sold the machine. So now we got some cash for it. Same thing, but now we got cash. Cash is an asset. We're going to make it go up, so we're going to debit cash. We're still going to get rid of the machine. So the 500 needs to go off the books. The accumulated depreciation needs to go off the books, just like we did up here. And we got cash now. We know cash is a debit balance. We need to make it go up by doing the same thing. Once we get those accounts in there, we can see what the plug is. What do we need in order to make the debits equal the credits? We need a loss again of only $20 this time. How do we know it's a loss? Because it's a debit, and debits are generally going to be losses. You can also think about the book value being 100, which is the 500 minus the 400, and we only got 80. Therefore, we only got 80. We think it's worth 100. We lost 20. C, same thing, except now we got $100. Well, that's the exact book value of the machine. So therefore, the machine needs to go off the books. Still, same transaction. We still need to take the accumulated depreciation off the books. Same idea. But now the cash is $100, which perfectly plugs it out. So now the debits equal the credits. We have no gain or loss. We sold it for the exact book value. Last one, the company sold the machine for 110. Hopefully you realize at this point we're probably thinking, well, that's probably going to be a gain this time because the book value is 100. We sold it for 110. We earned $10. Transaction's the same. Machine goes off the books. In that case, accumulated depreciation goes off the books. We know we got cash, in this case for 110. Now the debits are greater than the credits. Now we need a credit. And so we're going to call that the gain. So a gain is a credit because on the income statement, basically, it's kind of like income, meaning credits increase net income, debits generally decrease net income. Sales and revenue and income are credit balances and gains, and expenses and losses are debit balances. Income increases net income, and the expenses obviously decrease net income.